Thanks for being here. Let's start with maybe a quick introduction. Who are you, and what is your involvement in the nonprofit and the charitable space?
Yeah, well, first, thanks for having me here today, Craig. My name is Eric Saarvala. I'm the executive director of the Raymond James Canada Foundation. At the foundation, we have a donor advised fund program for our wealth clients, as well as we handle all of the corporate responsibility activities for Raymond James Limited, and that includes employee volunteerism, giving, disaster relief, and employee volunteer grants. And the other portfolio I oversee, I'm the head of corporate sustainability for Raymond James Limited and building out our sustainability and environmental governance, social ESG, environment, social governance, ESG activities at the firm.
Thank you for being here. I want to go back to one of the first things you said, which is donor advised funds. There's a lot of people who are donors who are able to support charitable causes that may not understand what that term is. And by extension, there's many people who may be on a board of directors for a charity that don't understand that term. Can you maybe explain what a donor advised fund is?
Yeah, absolutely. And it is a charitable giving vehicle that is one of the fastest rising in terms of popularity in the Canadian space and globally as well. And you can think of it in terms of a more convenient and cheaper alternative to starting a private family foundation or a private foundation. Many people think of it in terms as a charitable investment account where the fund holder can support charitable initiatives or charitable organizations that they care about most. And despite the fact that people haven't heard about donor advised funds and think that it's new, they've been around a while in Canada. In fact, the very first donor advised fund was established in 1952 at the Vancouver Foundation. And even earlier in the US, in 1931 was the very first donor advised fund. So they've been around a while. And the way that it works is you set up what's called a fund, or people also refer to it as a personal foundation. And that could be at a foundation or an operating charity. And then you name the fund. That fund can be named after your family. So the Jane and John Doe Fund or Foundation. You could also call it the ABC Foundation because you don't want to have that family legacy or that connection. And maybe you want to do a little bit more quieter philanthropy where you don't want to be solicited once charities know who you are. And one of the really popular aspects of a donor advised fund is you can have full anonymity. So you can recommend the grant that will go out and the charity will see this is an anonymous grant from, for instance, the Raymond James Canada Foundation.
So let's explore that. But then there's also, how does the money get out of the fund? Because, and I do want to come back to why people might want to give anonymously, but let's start with, how do you get money into this fund?
Yeah, so a donor will make an irrevocable gift, and that's the one piece to really understand about a donor advised fund is you make your donation to set up your fund. It is an irrevocable gift to that charity. So you no longer have that ability to really direct, it was probably the best word, direct how that investment is going to be used. It's now you are becoming recommending where you want your grants to go in the future. So if you set up a donor advised fund with an initial gift of $20,000, that could be cash, securities, benefits from proceeds from life insurance. There's a few different aspects on how you can fund that initially. And then you are recommending grants thereafter. And you set yourself up initially as the fund holder. You can set up successor advisors. So you have that potentially family legacy where your kids are involved in philanthropy, grandkids are involved as well, and you can make it a legacy giving opportunity.
So let's go back, and I'm comfortable using the Raymond James Canada Foundation as kind of the example. So let's say there's an individual that has one or more charities that they care deeply about that they want to support. Why would they set the money up in a donor advised fund instead of just gifting it to the charity directly?
So in my experience in this space, so if you make that large gift, that major gift to a charity, that money is then there. How are you being stewardship? Like, how are you being stewarded? What does that stewardship look like? What's the impact of that gift? If you're not happy with what your experience has been with that charity, that money is now, it's gone. You set up a donor advised fund, and it could be $50,000, and you're going to pay it over 10 years, let's say, and do grant recommendations, 10,000 a year on an annual basis. You can really gauge, how am I being engaged by that charity? Am I getting the stewardship that I want? Am I seeing the impact from this gift that we had discussed, and it's actually happening?
So is this a way, maybe an indirect way for charitably minded individuals to hold the causes that they're supporting a little? There's a little bit of an accountability piece now where if they don't feel that they're stewarding the funds in an appropriate direction, they can stop the donation and redirect their giving elsewhere?
It's quite possible for that, absolutely. So there certainly is a little bit more accountability involved. With that said, there's also no accountability on the donor advised fund provider. So for the Raymond James Canada Foundation, to ensure that we're getting those stewardship pieces, those impact reports, those acknowledgements from those grants, and directing it back to the client to make sure that both sides are getting exactly what they need out of that relationship of donor and charity. One of the pieces I will say around this too that's important to note, and it's a key feature of a donor advised fund, is it really separates what we'll say could be a taxable event from your philanthropy. And when you're saying, instead of making that gift directly to the charity, you could give your sale of a property proceeds directly to a charity. By setting up a donor advised fund, you can alleviate the tax event and get that tax relief from a charitable tax receipt, and think about that taxable event, whether it is sale of a business, sale of a property, stock options, and deal with that event first, and then step back and say, what is the change that I want to make in community? What is my philanthropic legacy? And it separates those two events, which gives families the time to really think about what does philanthropy look like for us.
So we're looking at a donation vehicle that's been around for the better part of 70 plus years and is only now really taking shape. What is the impact of this type of giving strategy having on traditional charities where maybe the money would have been directed to them in the first instance, but now it's being intermediated by this different structure?
Yeah, it's a good question. As somebody who's been at a charity and been on the receiving end of these grants, and the challenges that there can be around getting the fund holder information, the donor information, it's really about that collaboration between charity and donor advised fund provider. And yes, we have those donors or those fund holders that they self-declare. They want to be stewarded. They want to be invited to the events based on the giving level and recognition that they get with that grant. By the same token, as we mentioned earlier, if you set up the fund and it's the ABC fund, and you might have been giving directly to that charity before, what's the connection points for the charity to understand, oh, this is the same person behind the ABC fund, but if for some reason they're taking a little step back and they don't want to have that solicitation, that getting back into the pipeline and cultivation, and maybe they want to get a bigger gift out of you now that they see giving capacity and all of the prospect research that comes along with that. So it's understanding this is really donor driven. And yes, we want to move the pipeline and get as many donors in, minimize your attrition on the back end at the charity, and really give the best donor experience, fund holder experience that there can be. Again, this is where that DAF provider, that intermediary, really plays that matchmaker role, and it's important for them to understand what the charity is trying to do, understand what the donor needs are, the fund holder needs are, and communicate both. Because if the fund holder says, look, I'm not self-identifying with the charity, make the grant, just make sure that you get the impact reports, I want to see how it's doing, I'll step in if I need to, or I'll determine what next year's grant is going to be based on what I'm seeing. That has to be communicated. And that's where, in my experience, there's been the gap, because charities will not get that information, or they'll not deliver what the fund holder is expecting. And then that creates the fall off on gifts and potentially a grant one year and not the next.
So I think about a board director who maybe is not familiar with this structure and then they're looking at the annual report of giving, and you know, John and Jane Smith's name has dropped off the rolls, and they wonder, hey, they gave us $10,000 last year. How come they're not here? It may be, correct me if I'm wrong, it may be because they've said, we don't want you to know that we're giving you money anymore. But it's equally possible that the fund holder, John and Jane Smith have opened a fund, haven't declared their preferences that they'd like to stay in touch. And so how does a charity kind of reconcile that when they start to see gifts coming in from donor advised funds? What's the best practices that they can stay connected to the end people who want to be stayed in touch with?
Yeah, well, first and foremost, and this is an absolute, I'd say, misnomer or misconception in the space, is the charity will say, hey, donor advised fund provider, why are you not giving me the donor information? Because they are thinking that the donor advised fund provider, that foundation, is withholding that information. But the reality is, it is the fund holder, it is the donor that is indicating, here is the information that I want you to share with that charity. And at the end of the day, it is donor preference, in the same way that if the donor was dealing directly with the charity, they could say, put a do not solicit, they can put those restriction codes on. And with the privacy legislation and everything that we have in Canada, it's kind of part and parcel of that same process. If they don't want to self-identify, it's just important for the DAF provider to indicate to the charity, here's what those donor needs are. We will flow that through. We will be your conduit for stewardship. And the hopes, obviously, is that if the fund holder, if the donor is having a good experience with that charity, they will self-declare and put their hand up and say, actually, yes, that is me behind that. And then you can develop that stronger relationship with the charity.
But look, I'm a big fan of donor advised funds for clients because of the freedom and flexibility that it provides, but it seems like it may be difficult for organizations to look at. The fastest growing donation vehicle in the country is also one that can bring with it some opaqueness as to who's actually giving the money, because they're choosing to be anonymous. Though, how are organizations able to then cultivate a meaningful relationship that might bring that donor even more into the fold if they can't contact them because of the anti-spam laws? It seems like a difficult position to put a fundraising executive in.
Yeah, no, it absolutely is. But again, it goes back to the donor. What is it that they would want as part of their donor experience? Is it quiet philanthropy? Is it, I want to be fully engaged, I want to be a volunteer with the organization, I want to come out to your events? So it is really dictated by them. So managing those expectations with the charity is really kind of key. And you mentioned the word opaqueness. There is a lot of discussion around the fact that you have all of these funds that are locked up within donor advised funds. And if somebody gave directly to the charity, that is more money in community. I won't say from a charitable tax receipt standpoint, because you give to a donor advised fund, you get a charitable tax receipt. It's still a donation. It's just not within an operating charity where they're using that money right then and there for whatever their charitable purposes are. And some of the conversations that have been happening within the government of Canada, and a lot more happening in the US, around more transparency that's needed and more ability to deploy those funds, because it is a lot of funds that are locked up in donor advised funds right now, that the charitable sector, we know that they're suffering. How do we get more funds from these vehicles into community and into charity to make the change that we need to make?
But let's just jump on that, because a few years ago, the government of Canada increased what they call the disbursement quota. And it's now 5%. So you, as the executive director of a donor advised fund, your charity needs to distribute 5% of its assets every year in support of these other causes. Is that a way to get more money into the sector and out of kind of the structure, is to continue to increase the quota?
That's been some of the feeling. There was a lot of people that felt it should have been higher than 5%. And 5% is only for if the assets have an average value of $1 million or more. If it's under that, it's still 3.5%. But when you think about how big some of these donor advised fund programs are, even 5%, and many of them are way over that. It's 20%, 25%, because you have people who are distributing a lot more than that. But it's still a lot of money that is still locked up at the end of the day.
I want to come back to something you said right off the top. You said, think about it like a personal fund that you get to name, and you can name it the Sally and Joe Smith family fund. What is the difference between setting up a donor advised fund in that way versus setting up your own private foundation or private family foundation?
Yeah, so number one is cost. So when you have a private foundation, you are going to have a lot more administrative costs that are associated with that. When you have a donor advised fund, you don't incur those same type of costs. And audit is a great example of that. Number two, the transparency around it, and for good or for bad, there's people who have private foundations, and you can go on the CRA charity page and database and see exactly who the directors are. For fundraisers, it's fantastic because you can actually set up a fundraising strategy. Here's who all the board members are and the trustees. There's a lot of transparency around it. A donor advised fund, you don't know, to our point, what we're talking about, you don't know who the fund holder is, the donor is behind some of those gifts sometimes. So that's another reason why there's a bit of a preference around donor advised funds. There's a lot of feeling that for a private foundation, you should have a minimum asset base before it really starts making sense economically to have a private foundation. But it still is the Cadillac of giving, having your own private family foundation. It is a wealth status per se, but there's also the cons that do come along with that.
You talked about the costs of establishing a private family foundation. Obviously, donor advised funds also have costs. Can you maybe elaborate a little bit more what you mean by maybe it's being perhaps a bit less expensive to use a donor advised fund as the giving vehicle?
Yeah, so we talked about the audit that you would wind up having as a private foundation. There's legal costs, there's filing costs. Setting up the private foundation is going to be a cost in and of itself for the charity lawyer that you work with. So there's a lot of pieces around that. You're going to have your investment management fee for your advisor for investing the assets of the foundation. When you're looking at a donor advised fund, there's really two costs that are associated with it. One's the investment management fee, and one is typically an administrative fee from the foundation that's running the program. Sometimes they're blended into just one fee. Sometimes they're broken out into two different fees.
But even being in control, it's not as if you can withdraw that money. It's been irrevocably given to your family foundation.
Absolutely. And then you're restricted to granting the money to another qualified donee, of which the majority of those are registered charities in Canada. And then there's other subsets, organizations that falls under that qualified donee.
I guess what I'm curious about is the discussion that families might have about what is the best way to have the effect or the impact on the communities that they want to make a difference in. And donor advised funds is just a different vehicle. I think more people are familiar with that notion of a family foundation. So this requires a little bit of learning and a little bit of knowledge. But what about the family who's already had a foundation? Let's say mom and dad set up the foundation in the 1970s. Mom and dad are no longer with us. The kids are around, but they don't really want to have anything to do with the administration. How does the family foundation that is really only interested in giving in support of their community, how can they make the move to simplifying their life and maybe reducing some costs?
Yeah, and this is really a two-way street in the sense that you have folks who will start a donor advised fund and will incubate it over X period of time and then look to flip that into a private foundation and then just grant all the money from the donor advised fund into the private foundation. And then you have the example that you gave where the foundation has been around a long time. You're seeing all of the costs associated with it. Administration of a private foundation it's a lot. There are a lot of moving pieces. If you're not somebody that is familiar with that, then you're probably hiring someone on to be able to manage those day-to-day activities. You as the family are still making the decisions on where those grants are going and engaging with the charities. But you move that into a donor advised fund and you can make that grant from a private foundation to then be that first gift in creating a new donor advised fund. You can name it the exact same name as your private foundation, and you've just eliminated all of the administration. You don't have to worry about the tax filing because the donor advised fund provided the foundation that has all of the donor advised funds underneath that umbrella. It's just one filing. So there's eliminating all of those administrative pieces, but you are still in control of recommending where you want those grants to go.
And then fundraisers can't stalk you online by finding out that you're on the board of directors of a private family foundation.
There's that too. Yeah.
So there seems to be a lot of moving parts, and obviously the donor advised fund is a powerful giving tool, but how can people at charities work directly with the fund holder to try and make sure that the donations are solving the immediate, short, medium, and long-term problems of the organization they want to support?
Yeah, so my recommendation here, and you probably would be doing this with working with your major gift donors, is you're working through their advisor. And it's through their advisor that you're understanding that, oh, maybe they do have a private foundation, maybe they have a donor advised fund, and they're using that as the giving vehicle. You're still having that engagement with your clients or your donor's advisor. And then there's that opportunity to get those gifts through these different giving vehicles, essentially. Because folks are on boards, a lot of the time they have those connections to individuals who do have those wealth advisors, that you can start engaging with those advisors. And there's many charities that will host advisor events to say, hey, come out and learn all about what we're doing around X in the community. And those advisors will then take that back to their clients, in the same way that every charity wants to get in front of a donor advised fund program. And there are opportunities to do that based on the type of DAF program that it is, just in terms of whether it's stewardship pieces, maybe they're invited in to do a lunch and learn. So you have to take a look at the trend around your fund holders. What are they interested in? Because at the end of the day, the donor advised fund provider wants to provide as much value to their fund holders as possible. And if that is creating a closer relationship to the charities, then it's absolutely in the best interest that that donor advised fund provider aligns those interests and reaches out to the charitable sector to develop stronger relationships with them.
So let's walk me through an example, because this is an interesting question that comes up from time to time. So there's a fund holder who maybe is supporting a cause that they care deeply about through their donor advised fund, who then passes away. What happens to that supply of capital that was flowing to the end charity through the DAF account? What happens to that?
Yeah, so two pieces around that, and this is something that's important for us at the Raymond James Canada Foundation, is who's the successor advisor. So we want to make sure that there is that next person that, whether it's due to capacity issues or based on death, who are going to be making those decisions going forward. There's a possibility that successor advisor, unless there's something in place where the original fund holder said, I want you to continue with grants to X charity, it's up to them to, if they have a different charitable cause or an area that they want to see a change in, then they might start recommending grants to that particular area.
So the person who sets up the fund, just make sure I get this right. Yeah. The person who sets up the fund has the ability to appoint someone else to make the decisions on how that fund gets dispersed if they're incapacitated or they're no longer able to make decisions.
Yeah, that's correct. And there's a couple ways that, number one, it's setting up your successor advisor, but many folks who set up donor advised funds, they don't lock into a specific charity. They want to have that flexibility, because if they don't have that really good stewardship experience with them and they're not seeing the impact, they want to be able to grant elsewhere. So a lot of people will set up, I'm just supporting charitable causes, and it leaves it completely open. Now, there should be a letter of wishes that is also connected to this, where, in the case that something does happen and you don't have a successor advisor, what does that look like? And do you want to name charities? Do you want to do a spend down over 10 years? What is that going to look like? But you should always have it documented what those longer term plans are on how that fund is going to be managed.
I think what spills out of that for me is really the conversation around how much flexibility the donor advised fund structure offers, and it's still I think it's a bit of a challenge for people that are running traditional charities to deal with that when the people have options now, right? So does it impose, in your opinion, a higher quality of care or a quality of stewardship around the charity to build and maintain those relationships with the families that are ultimately supporting them?
With the families, with the advisors, with the donor advised fund provider that they could be using, a family office, absolutely, yeah. It's a different way of not a different way, but it's an innovative stewardship model to understand that you may not have direct access to the donor or the fund holder, but you still need to provide that same stewardship experience just through a third party.
So from a best practices standpoint, let's say there's a generous family that wants to set up a donor advised fund, and they have a primary goal of supporting a very specific cause. Let's paint a picture of what might be the best practice for them to go ahead in working with their professional advisors.
Yeah, and working with the professional advisors and their donor advised fund provider to say, how is this charity? Let me know, is there charity vetting that's going on here? Is this a charity that is a good charity? So yes, they are recommending it, but they're also, if you're not somebody who's used to donating, then you may need a little bit of help with that. So it's a matter of what does that look like? And another opportunity and great example that can happen in the ecosystem is you have donor advised fund providers that are having charity showcases saying, here's all the charities that are in the community, bring all of them out, showcase all of them on behalf of, and this happened with the Oakville Community Foundation. And fund holders will show up and you get to learn more about the charities in your immediate community. So creating those opportunities to bring fund holders and charities together with your donor advised fund provider and a community foundation is great at doing this. And there's over 200 community foundations across Canada. And that ability to showcase, to bring those two closer together.
From an RJCF perspective, what's the community that you're trying to serve?
We're agnostic, and that's the great advantage about our program, and our advisors work with their clients on what those strategic philanthropy needs are. It's about what is most important to them, what's the legacy that they want to create. Our ability to allow them, and there's programs out there where that initial capital and any subsequent donation that you give to keep growing your fund, the capital is locked in, and you only have that ability to grant out the income. For us at the foundation, you have that ability to grant capital and income. So you have an initial gift of $250,000. If something happens to the charity that you care about most, you might sit on the board and the roof caves in and they need money. You can take 125,000 of that 250 and you can recommend that grant. So having that flexibility around what that total fund looks like is very powerful.
So there's been a lot of talk about the changes taking place in the charitable sector. Donor advised funds obviously have a role to play. How is the landscape changing from your perspective?
Yeah, there was an absolutely wonderful report that the KCI and the Canadian Association of Gift Planners, CAGP Foundation, came out with a couple of years ago called Influence, Affluence, and Opportunity. And they were taking a look at the donor advised fund ecosystem in Canada and excluding the 100,000 donor advised funds in place at charitable impact. There was approximately just over 20,000 donor advised funds in Canada. Over half had been established with independent foundations or linked to financial institutions. And there was approximately 3,800 new donor advised funds opened up between 2019 and 2021. The total assets at the end of 21 were $8.5 billion. And in 2021, the mean average size of the donor advised fund per the report was $406,000. So when you think about the potential grants that could go out with that number of donor advised funds, huge opportunity. And it's estimated that 10% of donor advised funds in Canada hold in excess of $1 million. The other really big opportunity where, when we think about the wealth transition, TD Bank came out with a wonderful publication on Canadian women and philanthropy. Here's a few stats from that was really impactful to me. Donations claimed by women in Canada in annual tax filings nearly tripled to $4.3 billion in 2021, up from $1.5 billion in 2011. At current rates of growth, donations claimed by women are projected to reach $5.9 billion by 2030. And with wives, spouses, and daughters set to inherit $1 trillion over the next decade as baby boomers and their parents pass away, women are a driving force in Canadian philanthropy. And we know statistically that women's philanthropy and men's philanthropy they differ. So when advisors are thinking about who they're talking to about strategic philanthropy, and charities are as well, you need to have conversations with women. They are going to be the decision makers and the power philanthropists for years to come.
But I think you also need to be having conversations with donor advised fund providers, because there seems like if there's $8.5 billion of assets there that you're ignoring by not engaging with that community, that may be a good place to start to help close the giving gap that we're seeing here in this country.
Absolutely, and it would typically be both partners that would be the ones who have established the fund. So if the surviving spouse is the wife or the female partner, then there's going to be a chance that that's the person making all the decisions for the next little while. So it's important and incumbent on the charity and donor advised fund providers, on advisors, to be having those conversations.
Yeah, I had a conversation a few years ago about the power of a donor advised fund that has is not restricted that way. It was a family living in Calgary, and I said the successor to the plan could be your son or daughter who has moved to Edmonton. They said, no, Craig, you don't understand. Nobody from Calgary ever moves to Edmonton. So I don't know what that means. Listen, Eric, thank you so much for being here and sharing with us some of the best practices around using donor advised funds and the interaction that they have with the charitable community.
Thank you for having me.